Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning and implementation. So today's video is around the free trusts that you get supplied by insurance companies and why I believe they're often not fit for purpose. Hi, welcome back, and today's video is around the issues of the free life insurance policies that are free life insurance trusts, I beg your pardon, that are supplied by insurance companies when you take out a life insurance through them. Now, any financial advisor worth his salt should ensure that when a life insurance policy is taken out, that a trust is placed around it, with a possible exception being mortgage cover. But in most cases it makes sense to do so because it stops the value of the insurance policy dropping into a person's estate, because if you did that, of course, it would then be liable to inheritance tax, right? So by putting it into trust, it makes absolute sense to do so. So what's wrong with a life insurance policy through an insurance company? Well, if you do it directly, well, often we've come across policies where effectively we've asked to see the trust document and it hasn't been filled in properly. I even noticed one with a client, it hadn't actually been signed. So actually the trust is not effective in those circumstances. So if no one's checking it, how do you make sure it's correct? Now, presumably that if you've got a good advisor, they would check it and make sure it was sorted out properly for you. But however, what happens when somebody dies? Okay, so you take out a policy, you die, the value goes into a trust, and the trust is there available to your beneficiaries for whatever reason. And if it's an inheritance tax policy, it's there to pay the inheritance tax in the future. So all well and good, right? Okay, but what happens if you've got quite a big estate and even after you've died, your spouse still has an inheritance tax problem? So effectively what's happened is that the money gets paid out to the trust. Because it's an insurance policy trust, they shut it after a year or 2 years at most, and the money is paid out to the surviving spouse. But now the money's in her estate, right? So if the money's in her estate, or his estate, depending on who's died first, it's now added to the inheritance tax bill. However, if you take out a solicitor-driven trust, now this will be more expensive, but if you've got a big policy, let's say £1 million of cover, and that money then drops into a solicitor-driven trust, our trusts have the power to lend money. So the £1 million could be lent over a number of years to your spouse. Now, let's say she's spending all the money at, let's say, £50,000 a year, right? When she dies, that money is repayable back to the trust. Okay, if she spent the whole million over the next 20 years, she's just reduced her estate by £1 million, thus avoiding inheritance tax on £1 million, thus saving £400,000, all for the cost of a few £100s to put a solicitor-written trust in as opposed to a free one via an insurance company. This is one of the things that you need to deal with when you're dealing with experienced advisors who understand the difference between these things. So if you've got an inheritance tax problem, give us a call. If you found that video useful, give us a thumbs up. Thanks for listening, and bye for now. Bye.